The Dragonfly Doji Candlestick chart pattern is often used to indicate changes in market momentum. I'm going to show you what it looks like and how we calculate it on the TradeOxy platform. The Dragonfly Doji Candlestick chart pattern looks like a T, as you can see there. The candlestick chart pattern has a couple of conditions that need to be met in order for it to be considered a Dragonfly Doji. First, the open and close must be really close together, which is a characteristic of all Doji candlesticks. However, for this one, we need to make sure that the upper wick is very small with a very long lower wick, forming that really distinctive T shape. Here's how we calculate the Dragonfly Doji Candlestick chart pattern at TradeOxy for our scanners. First, we look at the body of the candlestick, which is formed by the open and the close, and we calculate to make sure that it's less than 10% of the size of the overall candlestick. Then, we have a look at the upper wick and we make sure that it's no more than 10% of the size of the overall candlestick, making it really small. Then we calculate the lower wick and make sure that it's at least 200% the size of the candlestick body. Once these three conditions are met, we label it a Dragonfly Doji Candlestick pattern and apply it to the entirety of the TradeOxy platform. The theory behind the Dragonfly Doji Candlestick pattern is that it identifies that the market is reaching either the top or the bottom of a particular price movement. That's because the candlestick kind of indicates that the price opens and closes the same with a large movement in between. The TradeOxy platform allows you to apply the Dragonfly Doji Candlestick pattern at scale to any of the tens of thousands of different assets that we track on our platform. Not only that, you can apply it to multiple different time frames for each asset, allowing you huge flexibility as you build your own alerting system.